If you're studying for any kind of accounting exam, you already know depreciation is going to be on there. It's a guarantee. But here's the thing. Just memorizing the methods, that's not enough to really nail the tough questions. So today, we're going to demystify the core logic behind the entire calculation. We're going to build your understanding right from the ground up so you can walk into that exam and tackle any depreciation question with total confidence. All right, let's jump right in.
Think of this as our little depreciation builder's kit. First, we'll lay the foundation and ask, what even is depreciation, really? Then, we'll get our 4 key ingredients together for the calculation. After that, we'll check out the instruction manual for the rules of time, learn how to handle some of those tricky in-life changes, and finally, we'll do a pro-level inspection to master all the common traps. By the end of this, you'll have the whole shebang down.
So, first things first, let's start with that foundation. What problem is depreciation actually trying to solve in the first place?
Okay, picture this. Your company just shelled out $1 million for a shiny new machine. It's going to last for years, so what do? Do you just record a $1 million expense this month and call it a day? Probably not, right? That wouldn't really capture the fact that this machine is going to be creating value for a long, long time. So, what is the right move here?
Well, this is exactly where depreciation comes in. And listen, it's not about the asset's market value going down. That's a common mistake. At its very heart, depreciation is a systematic allocation. All we're doing is taking the cost of that machine and spreading it out over all the periods it helps us make money. It's all about that matching principle, matching the expense to the economic benefit it provides.
All right, so to do that systematic allocation, we need a recipe. And you know what? That recipe has 4 essential ingredients. Let's break them down.
First up, you've got the cost. And this isn't just the price tag, we're talking about every single penny it took to get that asset ready to go. Second, the residual value. This is just our best guess of what it'll be worth for scrap at the very end of its life. Third, we have the useful life. How long are we actually going to use this thing? Could be in years, could be in units of production. Now, these 3 ingredients, they combine to give us the single most important number for our calculation.
And that is the depreciable amount. This is the total value we are going to expense over the asset's entire life. It is simply the cost minus what we think we can get back at the end. I'm telling you, if you get this number right, you are well on your way.
Let's make this real with a quick example. For our $1 million machine, let's just say we estimate its residual value at $100,000, and we plan to use it for about 5 years. There they are, our 3 key ingredients, all ready to go.
Okay, now we just apply the logic. First, we find our depreciable amount. We take the $1 million in cost, subtract the $100,000 in residual value, and that leaves us with $900,000. That's the total amount we need to spread out.
So, what's next? Well, we just spread that $900,000 over its 5-year useful life, and that gives us a yearly depreciation expense of $180,000. Simple enough, right? But here's the catch. Knowing what to calculate is only half the battle. The other half is knowing when.
And that brings us to the instruction manual for our builder's kit, the rules of time. This part tells us exactly when we need to start and stop that depreciation clock.
Now, this is absolutely crucial. Depreciation does not start when you buy an asset or when you pay for it. It starts when it is available for use, and it only stops when you sell it or officially classify it as held for sale. This means depreciation keeps on going even if the asset is just sitting there idle for a bit. That right there is a classic exam trap that gets people all the time. And what if you buy that machine on, say, October 1st? Well, you can't just take a full year's depreciation expense, can you? Nope. You have to calculate it pro rata, so proportionally, for the number of months it was available. Exam questions absolutely love to test this, so always double-check the dates.
Okay, so far so good. But, the real world, it isn't always so neat and tidy. Things change. So what happens when our estimates change halfway through an asset's life? This is where we get into the what-ifs.
This introduces a super important accounting rule. Let's say in year 3, you have a realization, hey, this machine is going to last for 7 years, not 5. So do you go back and fix the books for years 1 and 2? No way. The change is handled prospectively. You take the asset's current book value, its carrying amount, and you spread that remaining value over the new remaining life. We only look forward, never back.
And this whole forward-looking approach, it applies to all kinds of situations. Maybe you get new info on the residual value. Maybe you're dealing with complex assets, like an aircraft, where the engine and body are depreciated separately. Or maybe you do a major upgrade that extends its life. In all these cases, the rule is exactly the same.
Adjust from this point on. Don't mess with the past.
Okay, we have built our foundation. Now it is time for the final quality check. This is where we go from being just competent to truly pro-level by mastering all the common traps that examiners just love to set for students.
Let's run through our final inspection checklist. Remember, depreciation is about allocation, not market value. Land is never depreciated. An idle asset is still being depreciated. But this last point, oh, this is where it gets really clever.
So pay very close attention to this one. What happens if, partway through an asset's life, you get new information and now you think its estimated residual value is actually equal to its current carrying amount on the books? What would the depreciation expense be for that period? Think about it.
The depreciation expense becomes zero, a big fat zero. Why? Well, think back to our formula. It's carrying amount minus residual value. If those two numbers are the same, the depreciable amount is zero. There's nothing left to allocate. Understanding this little nuance proves you've truly grasped the core principle.
So, as we wrap this up, I want to leave you with this thought. Is depreciation just some mechanical math problem you have to solve? Or is it actually the story of an asset's economic journey and its contribution to a business, told period by period? Because when you start to see it as a story of allocation and not just another formula, that's when you've really mastered the logic, and that is how you're going to ace that exam.